Yes, all of you. Switch on the cameras. Yes, everybody. Quickly. Amta, Gautami, Chitralekha, yes. So, yesterday we revised 4 chapters, correct? Cost of capital, capital structure, leverages, and dividend decisions. Yes. All right. I hope your revision is going on. Full swing. Huh? Your mock exam this Sunday, la?
Yes.
Yes.
Yes, sir.
27th. Yesterday was the first day. I hope you started before the revision session or afterwards you started. ಬೆಳಿಗ್ಗೆನೆ ಸ್ಟಾರ್ಟ್ ಮಾಡದ ರಿವೈಸಿಂಗ್ ಆಫ್ಟರ್ ವಾಟ್ ಡಿಡ್ ಯು ಡೂ ಟಿಲ್ ದೆನ್ ಯು ರೀಡಿಂಗ್ ಆಡಿಟ್ಗೆ ಯುವರ್ ಎಕ್ಸಾಮ್ ಗಾಟ್ ಓವರ್ ವೆನ್ ಆನ್ ಮಂಡೇ ಆರ್ ಸಂಡೇ ಆಡಿಟ್ ಎಕ್ಸಾಮ್
Sunday.
ಸಂಡೇ ಮತ್ತೆ ಆದ್ರೂ ಒಂದು ಎಕ್ಸ್ಟ್ರಾ ಡೇ ಓಕೆ ಸೊ ಯು ಒನ್ ಲೆಸ್ ಡೇ ನೋ ದೆನ್ ಫಾರ್ ಎಫ್ ಎಮ್ ಎಸ್ ಎಲ್ ಮ್ಯಾನೇಜ್ ಮಾಡಿ ಐಡಿಯಲಿ ಯು ಶುಡ್ ಹ್ಯಾವ್ ಸ್ಟಾರ್ಟೆಡ್ ಆಫ್ ಇನ್ ದ ಮಾರ್ನಿಂಗ್ ಕರೆಕ್ಟ್ ನೋ ಸಾಗರಿ 7 days no for each subject. So Monday you should have started. Okay, anyway, doesn't matter. Plan it well, but don't take it lightly. Treat this as your final exam itself and give it your 100% or more than that. Okay. Yes, even those who are waiting in January. ನೆನ್ನೆ ಎಷ್ಟು ಜನ ಬಂದಿಲ್ಲ ನೋಡಿದ್ರ ಆಮೇಲೆ ಸೆಷನು ನೋಡಿಲ್ಲ 100% ಭಾವನಾ ಅಂತೂ ನೋಡೋದೇ ಇಲ್ಲ ಅವ್ರು ನೆಕ್ಸ್ಟ್ ಜಾನ್ವರಿ ಎಕ್ಸಾಮ್ ರಿವೈಸ್ ಮಾಡುವಾಗ ನೋಡ್ತಾಳೆ
ಹಂಗಲ್ಲ
ಹಂಗೆ ಶ್ರೀಚರಣ್ ನೋಡ್ದಿನೋ
Yes, sir.
Yes, good. Okay. You are able to recall something, Sicharan?
Yes, sir.
Something?
Yes, sir. Something.
Something. Okay. All right. So today we'll be discussing the remaining chapters, that is investment decisions, working capital management, ratio analysis. These are the important chapters, theory chapters. Like I said, we have not done it in the regular class. So once that is done, we'll be discussing even chapter 2 and then maybe some other theory points. Later on in the regular class, we'll do it. Okay? Yes. Investment decision. So 3 important decisions, right, for wealth maximization: financing decision, investing decision, and your dividend decisions. Investment decision is basically your long-term investment we are talking about. Yes or no? Normally, all these are from a long-term perspective. So your what do I say? We are not talking about short-term and working capital. I'm not talking about working capital investment here. Clear, all of you? That will be discussed in working capital management. Here, we're mainly talking about your investment decisions. So, where your sources of funds, right? What we discussed in capital structure and cost of capital, where will you invest that? That is what is discussed in investment decision chapter. Clear, all of you? Commonly called as capital budgeting. Yes, commonly called capital budgeting. However, in your syllabus, Shobini, it is called as what? Investment decision. It is concerned with what? Optimum utilization of funds. Yes, utilization. Clear, all of you? What is procurement and what utilization? Very two basic aspects of FM. Nenne tani odiddo.
Effective procurement, efficient utilization.
Efficient procurement of funds and effective utilization of funds. Efficient procurement and effective utilization. So the optimum utilization of funds to maximize the wealth, right? So what is net present value? The present value of the cash inflows minus the present value of cash outflows. The difference of this is net present value. Basically, NPV, Kanishk, is not the profit. Rather, it is the wealth creation. Correct? So if a project has a positive NPV, it means that so much of wealth is being created. Clear or not? Yes. So if a positive NPV project is taken on by the company, it should directly impact the share price. Right? Theoretically. Yes, theoretically speaking, it should definitely impact the share price. Right? All right. So what does capital budgeting involve? First of all, you should choose those projects which are in line with the long-term objectives of the company. That is very important. There are hundreds and thousands of projects. You will not sit and evaluate everything. First, shortlist those projects which are in line with the long-term objectives. Sit straight and look at the screen, not at your books or anywhere else. ಏನಕ್ಕೆ ಕಣ್ ಕೆಳಗಡೆ ಹೋಗ್ತಿದೆ? ಕ್ಯಾಮರಾ Look at the screen. Yes. It should be in line with the long-term objectives. After that, then you will evaluate the projects, right? You will perform the capital budgeting techniques, and then you will choose which project to be taken up. Clear, all of you? So first is identification of the projects which are in line with the overall objectives of the business. Overall objective. Next, then you estimate and evaluate all the incremental cash flows. Yes, what are the three types of cash flows? First one, you have your initial investment. Then you have your operating cash flows, intermittent cash flows, right? Incremental cash flows, right? So all these your intermediate cash flows, and finally you have terminal cash flow. Clear, all of you? Initial investment could be your fixed asset as well as working capital investment sourced from equity, debt, or a combination of equity and debt. Clear, all of you? Then you have your intermittent cash flows, intermediate cash flows, right? What we need is CFAT, cash flow after tax, right? That is EBIT into 1 minus T, all of you, EBIT into 1 minus T plus depreciation. Why do I take EBIT? Because interest is already factored in your KO. In the discounting rate, interest is already considered. Therefore, what we consider here for calculating CFAT is EBIT, EBIT minus into 1 minus T, that is after tax. After tax. And then add back depreciation. This is CFAT. Clear, all of you? Yes. So you take CFAT for incremental cash flows, discount it at what rate? At the discounting rate. What is the discounting rate? Expected rate of return, opportunity cash, cost of capital is the first preference because it is difficult to determine opportunity cost, right? Normally what we consider KO. Understood? So KO is not my first option. KO I take when the opportunity cost or the required rate of return I don't know. Then I go for KO. Is this clear? Right? Overall cost of capital. Discount it at overall cost of capital. Find out what the present value of the cash inflows is. This is my present value of the incremental cash flows. Then initial investment, normally it is at T0. Initial investment normally T0, but I told you that if there is any other investment, say increase in the working capital, say if there is a additional plant and machinery purchase in between the project, then you take it as part of your cash flow itself, investment itself. That is the first X. Take it as part of X. Understood? And then find out what the present value is based on the number of years. Is this clear? Right? So you find out what is X, then Y, and then finally Z. Z is your terminal cash flow. Terminal cash flow basically is your recovery of working capital and your salvage value. Right? Working capital, if nothing is mentioned, it is assumed that it is released at the end of the maturity period, term of the project. Clear? It is released at the end of the project. Right? Find out what the present value of all these three is. Clear, all of you? Then X, so your Y you take first, Y minus X plus Z basically gives your net present value. Clear? Right? So this is what I was telling. First step is what? I'm still in the starting. First step is identification of the projects based on your overall business. Then you do perform an estimation of the, post-tax incremental cash flows. Right? And finally, you select the project based on your capital budgeting techniques. One of the techniques already discussed is NPV. Right? Then you have your IRR and your profitability index, net profitability index, discounted payback period, accounting rate of return, etc. Clear, all of you? Based on these techniques, we'll be selecting which project to be chosen. Understood? Right? What is the purpose now? Why do we perform these investment decisions? Because huge investment is involved. It is normally irreversible. You cannot reverse the decision once taken. Correct? Then time period is long. Yes or no? Time period is long. Right? So therefore, it makes it very complicated, and hence it is that is why we perform Shobini 6-state capital budgeting techniques. Is this clear? Right? All right. I think with this basic, we can go through your CAPS material, revision material. All of you open page number 40, I think 8. Correct? Yes, page 48. All of you got it?
Yes, sir.
Yes. Right? Investment decisions. It is concerned with the optimum utilization of funds to maximize the wealth. Again, maximization of wealth always of the organization and in turn the wealth of its shareholders. It is also known as capital budgeting. Applying the principles of budgeting for capital investment. Capital budgeting involves identification of investment projects that are strategic to the business's overall objectives. Right? Next, estimating and evaluating the post-tax incremental cash flows for each of the investment proposals and then selection. Right? This is basically my capital budgeting. Next, purpose, because there is substantial expenditure, right? Next, investment decisions are related to fulfillment of long-term objectives and the existence of an organization. To invest in a project, a substantial capital investment is required. Hence, a thorough study and planning is required. Correct? Because of substantial expenditure. Next, long time period, right? The capital budgeting decisions has its effects over a long period of time. Therefore, it is important. Irreversibility. Once you take a decision, it is irreversible. The reason may be upfront payment of amount, right? Contractual obligations, technological impossibilities, etc. And complex decisions involves an assessment of future events, which is difficult, right? Difficult to predict. Further, it is quite difficult to estimate in quantitative terms all the benefits of the costs. Okay. Capital budgeting process. First one is planning, identification of potential investment projects. If merits are little, it's rejected. If merits are promising, then you go to the evaluation phase. From planning phase, you go to evaluation, right? Evaluation, then you have selection, implementation, control, and review. Arthaita? Right? Obviously, you have to elaborate these points, and in your regular material, we have discussed all of these points in detail. Types of capital investment decisions based on the firm's existence. Okay, you have replaced, mark this important, replacement decisions. Very frequently asked examination questions. Right? You have an old machine. Should you replace it or not? Or should you continue with the old machine itself? Replacement decision. Expansion decisions, diversification decisions, right? Mutually exclusive. This is what based on decision situation. Mutually exclusive. Either this or that. Either project A or project B. Accept, reject. Only project A they've given. Should I accept project A or not? Accept, reject decision. Contingent decisions, right? Based on certain contingent events, right? That is contingent decisions. Steps of capital budgeting, procedure, estimation, we already discussed, evaluation, and then determining the minimum required rate of return. What is my WACC to be used as a discounting rate? Estimation of cash flows and capital budgeting techniques. Estimation of project cash flows, capital budgeting analysis considers only incremental cash flows. This is what we have discussed and studied. Remember, it is always the incremental cash flows. Even for replacement decision, I will be choosing the incremental cash flow. Correct or not, everybody? Important task is to estimate future cash flows, which is a difficult thing to do. Limitations of accounting profits. Time value of money is not considered. Most important thing. Non-cash items are also considered like depreciation, etc. Even though cash flow is not there. The cash flows are estimated on the basis of input provided by various departments. You are dependent on so many departments. Correct? Sorry. So what happens? Cash flow when you have to do, you have to go and ask all these departments. Right? Then only you can predict the future. Right? Accounting profitably, you normally don't do that. Then project cash flow stream, cash outflow is there and cash inflows are there. Calculating cash flows, depreciation, it's a non-cash item and itself and does not affect the cash flow. However, consider tax benefit, all of you. That is why we do EBIT. We first minus depreciation, find out EBIT, less tax and then add back depreciation because you want to consider tax benefit of the depreciation. Hence, it is considered as cash inflow. Opportunity cost. Foregoing a benefit due to choosing an alternative. Did you know the definition already in opportunity costs? Yes, opportunity costs are considered for estimation of cash outflows. Sunk cost. Opportunity cost always relevant, right there. Right? This is always relevant. Sunk cost. Right? It is irrelevant. Not considered for decision making. Already incurred. Outlay of cash that has already been incurred in the past and cannot be reversed in the present. These costs do not have any impact on, no impact on decision making, hence should be excluded from capital budgeting analysis. For example, consultancy fees to a firm to prepare a project report for analyzing a particular project, right? So it is already incurred. Why will you consider that cost, right? Another example, survey cost you have done. Same thing, same answer. Working capital. Initial working capital is a cash outflow at T0, and at the end, T1, working capital release will be an inflow. Yes, additional working capital required is treated as cash outflow, right? This should be taken as part of X. I hope you will make that note. Yes, Bhavna, taken as part of X. Reduction of working capital should be treated as cash inflow. Artha? If the working capital is reducing, that means you are releasing that cash automatically, right? Debtors have come down. That means you have learned an indirect cash flow method. If debtors balance is coming down, that means cash inflow is increasing. If nothing has been specifically mentioned for the release of working capital, it assumes that the full amount has been realized at the end of the project released, right? Allocated overheads, is it required? Is it necessary for decision making? Already incurred, therefore not considered for decision making. Additional capital investment relevant. Additional capital investment considered as cash outflow at the period of time. Categories of cash flow, this is what I told you. Initial cash outflow X, interim cash flows Y, terminal cash flow Z. However, if there is any interim cash flow which is in the nature of working capital, right? Or say your investment in plant and machinery, etc. Even this too, even though it is part of interim, treated as part of X. And then when you are making the analysis, don't use the word initial, just write cash outflow. Artha aita? In this case, do not use the word initial, just write cash outflow, but take it as part of X, very clear. That is how all my students will solve. So X will be cash outflows, Y will be interim cash flows, and then Z would be my terminal cash flow. Next, basic principles for measuring project cash flows. The treatment of depreciation is based on block of assets concept. Idu income tax in detail, it has been discussed. Yes, the same concept you have to apply here also. You know that if the block is existing, even though the asset is sold, if the block exists, then the same depreciation computation will continue. Nenpidya, all of you. Yes, only when the block ceases to exist, that is when depreciation will stop, and then that is when you'll go for capital gain taxation. Kottalva? Capital gain agidya ಈಗ ಇನ್ನ ಆಗಿಲ್ವಾ?
Agila.
Not yet. But this part is covered in your business income, I'm sure. Yes, no.
Yes.
Sir ಮಾಡಿಲ್ಲ ಅಂದ್ರು ನಾನೊಂದು ಕ್ಲಾಸಲ್ಲಿ ಮಾಡಿದ್ದೀನಿ ಅಲ್ವಾ? To the extent it is relevant for FL. So that concept you have to remember here. Okay. So Ade concept has been explained in detail here. You can go through it. Okay. All right. Exclusion of finance cost principle. This is what I explained in the start itself. Because finance cost is a part of my KO, it already includes, right? It includes interest cost. Therefore, you have to consider CFAT is what? CFAT is equals to EBIT into 1 minus T, right? Plus depreciation. Right? That's what is given here. Right? That's what is given here. PAT plus depreciation tax shield, or EBIT into 1 minus T. This is or aita divided alla. No PAT is nothing but EBIT into 1 minus T plus depreciation. Capital budgeting techniques, traditional techniques are my payback period and accounting rate of return. What is payback period? Number of years or whatever period, months, etc., within which the initial investment is recovered. Understood? All of you? That is my payback period. Accounting rate of return based on accounting profits. It is calculated. Accounting profit divided by average investment. Net present value, we just now discussed. Profitability index is the present value of cash inflow divided by present value of cash outflow. Right? NPI. NPI illa. Actually, one more will be there. NPI. Net profitability index. What is that? NPV divided by present value of cash outflow. Clear, all of you? Internal rate of return, you'll use interpolation technique. Yes. Discounted payback period. Right? Here you will write discounted cash flows will be used. Right? Same concept. Cumulative cash flows you have to find out and then use the table and do it. Nenpidya. How do you find out the payback period all of you? Whether discounted or normal payback period, the answer is same. Only thing is in discounted payback period, you do discounted cash flows. In your normal payback period, you will use absolute cash flows. Artha aita. So how will you do it? You will take, yes, your cash outflow. Clear all of you. Cash flows of the year, cumulative cash flows you'll do. Understood? So if you take the cash flow is as negative, concentrate all of you. If you take the cash flow as negative, right, cash outflow, the initial cash flow is negative, and then you keep adding the cash inflows of each year, you will keep checking the point at which at 1 year it will be negative. Next year it becomes positive. Understood? Say year 3 it is still negative. Year 4 it is becoming positive. What is payback period? Year 3 plus whatever that cash flow is short negative, but you'll not write with symbol, you'll write in absolute terms that short. Say for example it is minus 500 lakhs. In year 3, say the cumulative cash flow is minus 500 lakhs. Clear all of you? Then you'll write year 3 plus 500 divided by what is the next year cash flow. Say next year cash flow is 1000, right? So 500 by 1000, 0.5, payback period is 3.5. Is this clear? Similarly you do for discounted cash flows, discounted payback period. Understood? Right? Then modified rate of return. Internal rate of return, what is the concept here? Basically, IRR gives you the rate of return. NPV, I told you, doesn't give you the return. It basically tells you the wealth creation. Clear all of you? Whereas IRR is giving you the return. Yes or no? The assumption in IRR is what? Assumption in IRR is what? That all the intermittent cash flows are reinvested at what rate? All the intermittent cash flows are reinvested at what rate in IRR? Take a wild guess at least. You remember, you know this. Ready?
Cost of capital.
It is in IRR, the assumption is that they are reinvested at IRR. That is why we say it is an aggressive assumption. Nenpidya? Yes, ಸ್ವಲ್ಪ ಈಗ ನೆನಪಾಯ್ತಾ? Right? It is an aggressive assumption that you are assuming that all the intermediate cash flows also can be reinvested at IRR itself. Clear all of you? Therefore, you have modified internal rate of return, which says that, right, don't assume that the intermediate cash flows will be reinvested at IRR. Take another rate of return which is more realistic. Understood? If nothing is given, we take it as KO. Is this clear? If nothing is given, we take it as KO. So all the intermediate cash flows, you will take it to the last year. You will take it to the last year, compounded at what rate? At your new rate or the KO. Understood? Then the terminal cash, whatever is there, that you discount it to the present year, right? That is T0. You discount it to T0, and this discounted cash flow, when it is equated to the present value of cash outflow, what is that rate at which, if you discount the terminal cash flow to the present year and it equates to the present value of the cash outflow, this rate is called MIRR, modified internal rate of return. IRR ಅಲ್ಲಿ present value of cash inflow will be equal to present value of cash outflow. Yes, sit straight. At IRR, present value of the cash inflow will be equal to present value of cash outflow. Yes or no? Everybody, correct? Same way for modified internal rate of return, the terminal cash flow will be discounted terminal cash flow will be equal to the present value of the cash outflow. Is this clear? Right? Terminal. So all the intermediate cash flows you take it to the last year, compounded at what rate? At your required rate or the this KO. Clear all of you? Yes. This is the concept of modified internal rate of return and internal rate of return. Right? Now, payback period, when there is uniform cash flows, that means each year the amount that you receive is same, then formula is very simple. Initial investment divided by my annuity, right? Divided by annuity. Is this clear? That is annual expected after tax net cash flow. If there is non-uniform cash flows, I already discussed cumulative cash inflow table haki ಮಾಡಬೇಕು. ಅರ್ಥ ಆಯ್ತಾ? Using fraction. Yes. Advantage of payback period, easy to compute, easy to understand. Length of the payback period, right? Estimate of a project's risk. Longer the payback period, the riskier it is. Artha aita? Those are the advantages. If the payback period is more, that means the risk is high. Is this clear? However, disadvantage is very important, especially from an examination perspective. Okay, what are the limitations of payback period? It ignores time value of money. Second, it failure to consider total profitability as it ignores cash flows after the payback period. Right? After the payback period, I'm not considering at all. Places much emphasis on short payback, thereby ignoring long-term projects. Okay. Payback reciprocals, this will give you something related, similar to your IRR. A major drawback of payback period is that it does not indicate any cutoff period. Correct? Payback period, there is no cutoff period. So you compare it with your target payback period. Understood? Payback period is compared with the target payback period, but there is no cutoff period as such. Reciprocal of the payback would be a close approximation of IRR. Very important. But if the life of the project is at least twice the payback period. Okay? If the life of the project is at least twice the payback period, then the reciprocal of the payback period will be a close approximation of IRR, and the project generates an equal amount of the annual cash inflows. Payback reciprocal is equal to average annual cash inflow divided by initial investment. Is this clear? All of you. This gives you the return. Yes, return, no, common sense. Look at this. Average annual cash inflow, what you're getting, divided by my initial investment will give you the return. Is this clear? Right? Accounting rate of return, ARR, or the average rate of return, measures the average annual net income of the project as a percentage of the investment. Investment can be either initial or average investment. Okay? Accounting rate of return, average annual net income divided by investment. Different types of calculations of ARR, annual basis. So ARR is equal to profit of the year divided by investment at the beginning of the year. Understood, all of you? At the beginning of the year. Next comes total investment basis. Accounting rate of return is equal to average annual profits. Average annual profit divided by investment in the beginning. Average investment basis, average annual profit divided by average investment, wherein average investment is equal to, if you remember your average level formula in your material chapter costing only, similar formula here also, half of initial investment minus salvage value. Right? Initial investment minus salvage, other half. Is this here? Plus salvage value plus additional working capital. This will give you your average investment. Right? Because salvage value is there throughout. Right? Salvage value is there throughout, just like your minimum level. NPDA. Yes. There, what was the formula? Minimum level plus half of ROQ. NPDA. This is my average level formula. Similar concept here. Half of initial investment minus salvage value. Right? Plus salvage value plus additional working capital give me my average investment. Advantages of ARR. Right? Uses readily available data. I don't have to do anything. It's already there. Accounting rate of return. Yes. This method may also mirror the method used to evaluate performance on the operating results of an investment and management performance. Using the same procedure in both decision making and performance evaluation ensures consistency. See, management's performance may be evaluated based on accounting profits. So when you take a decision also based on that, they are saying it will be consistent. Considers all net incomes over the entire life of the project and provides a measure of the investment's profitability. Limitations of ARR: ignores the time value of money. Ignores time value of money and considers the value of all cash flows to be equal. All of you are understanding? Right?
Yes, sir.
Right? So all cash flows same. No, time value of money is not considered. 1 rupee today is equal to 1 rupee tomorrow. Artha. That's the major disadvantage. Next. Different accounting procedures. Private limited A and B and C may have different accounting policies and procedures because of which different and comparability is difficult. Whereas cash flow for any company is same. Understood? Yes. Uses net income rather than cash flows. Right? Net income is a useful measure of profitability, the net cash flow is a better measure of investment's performance. Inclusion of only the book value of the invested assets ignores the fact that a project can require commitments of working capital and other outlays. What you're doing here is you're only considering your accounting profits, you're ignoring the investment that is required. Artha right? So you're forgetting the working capital investments, etc. that is required. Is this clear? Because you're taking average investment, Artha you're ignoring the working capital. Capital budgeting techniques. Sorry, discounting technique. Considers time value of money. This is the traditional method I took. All of you understood? Traditional method is done. Next one, discounting techniques. So consider time value of money and discount the cash flows to the present value. Determining the discount rate. Normally use, right? Firstly, you have to use opportunity cost of capital. However, it is difficult to identify. Therefore, you go for KO or WACC. Net present value already discussed, right? Decision making. If NPV is greater than 0, you accept. If NPV is less than 0, you reject. Right? You should know the advantages and limitations of each of the capital budgeting techniques. Right? This will consider time value of money. Whole stream, unlike payback period, which is only until the payback period, whole stream of cash flow is considered. Net present value can be as an addition to the wealth of the shareholders, which is in conformity to the basic financial objectives. Right? If NPV is positive, it adds to the wealth. NPV uses discounted cash, which enables comparison of different projects. Right? Limitations, difficult calculations, accuracy of NPV depends on accurate estimation. Okay, which is not easy. Then the decision under NPV method is used on absolute measure. It ignores the differential in the initial cash outflow, size of different proposals, etc. while evaluating mutually exclusive projects. That is why you have PI. Artha. That's why you have PI, correct? Because this ignores the size. Profitability index, also called desirability factor, net present value index method. Sum of discounted cash inflow divided by initial cash outflow or total discounted cash outflow. If PI is greater than 1, accept. If less than 1, reject. In case of mutually exclusive projects, project with higher PI should be selected. Right? This helps in ranking various projects. Advantage of profitability index uses the concept of time value of money. It's the relative measure of project's profitability. Limitations of PI. If the projects are indivisible, then it is difficult to apply PI. NPDA, all of you will discuss in the class. If the project cannot be divided, then how do you apply profitability index? For example, if you remember your key factor problem in marginal costing, all of you sit straight. Key factor problem in marginal costing, resource that is available minus resource utilized for rank 1 product minus resource utilized for rank 2 product. Balance resources available will be used for your rank product 3. Artha right? Balance resource available divided by resource required for 1 unit of the product. Division ಮಾಡಿ ಬ್ಯಾಲೆನ್ಸಿಂಗ್ ಫಿಗರ್ ಯು ಫೈಂಡ್ ಔಟ್. ಏನಾದ್ರೂ ನೆನಪಾಗ್ತಾ ಇದೆಯಾ ನಿಮ್ಗೆ? ಕಾಸ್ಟಿಂಗ್ 1 ವಾರ ಮುಂಚೆ 2 ವಾರ ಮುಂಚೆ ನಾನೇ ಮಾಡಿದ್ದು ಅಲ್ವಾ? ಅದೇ ಸಬ್ಜೆಕ್ಟ್. ಎಸ್. ಸೊ whatever balance resource available divided by resource available required for 1 product divided, and then you will identify, okay, so many products I can sell. Is this clear? So my total demand was 1000, but I'm selling only 100 because only so many resources available. Got it? This is how ranking works. Now in PI, profitability index, I am now talking about we are now not going to talk about products, but rather projects. So resource available is basically your capital. Capital utilized. Robin is it straight? Yes. Capital utilized for project 1. Yes. Capital utilized for project 1. ಹಂಗೆ ಇರು ನಗ್ನಾಗ್ತಾ ನಿನ್ ನೋಡಿ ನನ್ಗೆ ದುಃಖ ಆಗ್ತಾ ಇದೆ ನಿನ್ ಮುಖ ನೋಡಿ. So no matter whatever it is, smile ಅಷ್ಟೇ. Smile. Okay. So project 1 ನಲ್ಲಿ Project 1 say capital required is 100 lakhs. Project 2 capital required 300 lakhs. You're left with 200 lakhs. Got it? In marginal costing, what you would have done? Okay, 200 lakhs only. How much part of the next project I can invest? Because the capital required for project 3 is say 500 lakhs. Understanding? But if the project is not divisible, that means either you have to accept the entire project or reject the entire project. Got it? In such cases, PI fails, the ranking fails. You have to go for what? Permutation combination. That problem I've done in the class. Arthak idea. In investment decision, there are too many project problems. There are too many variety of problems. I may not be able to do all of it. I'm covering most of it in my theory. Concentrate. Got it? This problem I will not be discussing. I hope you are able to recall wherein different projects, project A, B, C was there. We did different combinations. A, B, A, C, A, B, C, ನೆನಪಿದೆ ನಿಮಗೆ. And then we told, okay, if there is any synergy benefits, yes, because of these two, the investment required is lesser. All those combinations and we treated. This, when PI fails, we do this approach. Got it? Right? So normally PI is used when capital rationing, when there's capital rationing, when capital available is scarce. Got it? If capital is abundantly available, like my monopoly industry in marginal costing, then I don't have to bother so much. Arthak idea. Then I can invest in all the projects that falls in line with my long-term objective and that satisfies my capital budgeting techniques. That is, there is positive NPV, there's good IRR, etc. Understood? Right? So projects are indivisible. That is my limitation of profitability index. Once a single large project with high NPV is selected, possibility of accepting several small projects with which together may have a higher NPV than the single project is excluded. This is a limitation. Okay, situations may arise where a project with a lower profitability index selected may generate cash flows in such a way that another project can be taken up, right? 1 or 2 years later, the total NPV in such case being more than one with the project with highest API. What they're trying to say is when the periods are different, right? When periods are different, you choose, say, for example, one PI with a which is very high. The period of this project is say 10 years. Artha you have rejected, say, a project which PI is little lower, but term is 1 year. What can happen? If you select this project, for 1 year, you'll have less NPV. Okay. But in the second year, you can select a project with PI which is far greater than the first project. Right? So this is the limitation if you choose a project based on PI. Internal rate of return considers the time value of money, the initial cash investment, and all cash flows from the investment. But unlike the net present value method, it does not use desired rate of return, but estimates the discount rate that makes the present value of the subsequent cash inflows equal to initial investment. Under IRR, it is a discounting rate that equates present value of the expected cash inflows with the initial cash flow. Clear? Right? So basically, present value of cash outflow will be equal to present value of cash inflow. Right? This rate is nothing but IRR. At IRR, this statement holds good. Right? It's calculation better. You know interpolation technique. Yes, everybody. What will you do? First, find out what is the NPV at the lower rate. What is the NPV at the higher rate? Right? The difference between these two, you find out. Right? So then lower rate and higher rate. What is my IRR? IRR is a question mark. The difference between these two leads to a difference between this. So you divide it. So you cross multiply, you'll get the answer. Is this clear? Right? So same thing in a formula is given here. Lower rate plus NPV at lower rate, NPV at lower rate minus NPV at higher rate into HR minus LR. Right? Next, when cash inflows are not uniform over the life of the investment, the determination of the discounting rate can involve trial and error and interpolation between discounting rates. Right? Now, How do you choose a discounting rate for IRR? I had given you step-by-step approach. Nenpidia, all of you. Step by step we had discussed in the class, obviously that I cannot discuss now. But each step I had given, how do you identify what will be L and what be R, depending on the gap. Yes, depending on the gap, depending on the cash flow pattern. If it is favorable pattern or unfavorable pattern. Idea, yes or no?
Yes.
Right? All right. Yes. Sorry, I'm not screen sharing. Yes. So acceptance rule, the use of IRR as a criterion. If IRR is more than my cutoff rate, if IRR is more than cutoff rate, you will accept. If it is less, then you will reject. Mutually exclusive projects can create problem with IRR technique as IRR is expressed in percentage and does not take into account scale of the investment or the quantum of money earned. The reinvestment assumption, this is what I told you. The net present value technique assumes that all cash flows can be reinvested at the discounted rate used for calculating the NPV. In contrast, IRR technique assumes that all cash flows are reinvested at project's IRR. This means that projects with heavy cash flows in early years will be favored by the IRR method vis-a-vis projects which have larger cash flows in the later years. Multiple IRR, when project cash flows change signs or reverse during the life of the project. I told you a heavy investment in between the life of the project. Right? This could be an example wherein the sign reverses. In such cases, you may have multiple IRR. Advantages of IRR and limitations. Right? Advantages, the method used for the concept that this uses time value of money. Advantage, all cash flows in the projects are considered. All the cash flows are considered, unlike payback period. IRR is easier to use as instantaneous understanding of desirability can be determined by comparing it with the cost of capital, right? And IRR technique helps in achieving objective of maximization of shareholders' wealth. It's a tedious process, right? If there are more than one cash flow, right, between the cash inflows, there can be multiple IRR. This is what I told you. When cash outflows can be there, multiple cash outflows, that to higher amounts, then you'll have multiple IRRs. Creates a peculiar situation if we compare two projects with different inflow and outflow patterns. Ignores a firm's ability to reinvest at different rates because assumption is it is reinvested at IRR. Discounted payback period. Yes. So the same payback period formula I told you. Check the present value. The initial cash flow, cash outlay is 30,000. Clear all of you? So payback period is actually 10 years itself here, almost 10 years it's getting payback. Modified internal rate of return. MIRR addresses the deficiencies of IRR, eliminates multiple IRR rates, addresses the reinvestment rate issue and products and produces results which are consistent with the net present value method. This method is also called terminal value method. Why? Because you take all the cash flows to the terminal year. All cash flows apart from initial investment are brought to the terminal value using an appropriate discount rate. This results in a single stream of cash inflow in the terminal year. The MIRR is obtained by assuming a single cash outflow in the 0th year and the terminal cash inflow as mentioned above. Right? If it is more than the required rate of return, you accept, if it is less, you reject. Comparison between net present value and IRR. Both net present value and IRR methods are discounted cash flow methods which consider time value of money. Both the techniques consider all the cash flows, right? What is the different conclusion in the following scenarios? Scenario 1, scale or size disparity. IRR is a relative measure, right? And NPV is an absolute measure. In case of disparity, both may give contradicting ranking. Scenario 2, time disparity in cash flows. Basically, you have unequal lives. Time disparity is different. This is disparity in life of proposals. That is when you have unequal lives. All of you remember there are two methods. One is annual equivalent NPV. Able to recall? Yes, no. Then second is the LCM method, right? LCM method, that is replacement chain method. Okay. So replacement chain method, and then you have your equivalent annualized criterion. For both of these methods, the assumption is that the projects are repeatable. We assume that the projects are repeatable. Okay. Today you have class at what time?
7:30, sir.
7:30.
Here, equivalent annualized criterion. How do we do this? Find out your normal NPV. Clear all of you? And then divide it by my present value annuity factor. You'll get your annualized equivalent criterion. Clear all of you? Yes, no. And this is my decision criteria, which is the summary of the entire chapter. Non-discounted techniques and discounted techniques, your payback period, accounting rate of return. What is the, for independent project, when payback period is less than or equal to maximum acceptable payback period, then you accept. So these are the decision criteria. For mutually exclusive projects, project with the least payback period should be selected. Are you understanding the difference? This table is important. Write it in your notebook if you have not written. It is there in this table. I think it is also a part of your formula table. Artha. But once you write so that it sinks in your head. Clear? Yes. That's it. So this is the theory of my capital budgeting problem. Clear all of you? Yes. All right.
Yes.
Let's go through the RTP first. Page number 31. Sorry, RTP is 507. This is the lengthy case scenario. ನಾನು glance ಮಾಡ್ತೀನಿ ಅಷ್ಟೇ. Okay, case scenarios normally will have a lot of points ಅಲ್ವಾ. So same way, story ಇದೆ ಇಲ್ಲಿ. Okay. Mint Technologies, a startup in IT infrastructure space, is planning to enter the computer networking market with a specialized offering VPN connectivity solutions. Okay. Then it won't spread across 100 branches. The leadership team is excited but cautious as this move requires significant upfront investment and ongoing operational capability. To evaluate the financial viability of this project, you have been hired as a consultant. They have forecasted their numbers of 5 years life of the project, and they have assumed that they will grow at an industry average of 3% afterwards. Okay. So whatever the cash flow is at the end of the 5th year, all of you, you will take the growth rate to be 3%, and you know A by I formula. Gotta? That formula, you will take terminal year and then discount it till date. Are you understanding? Because what have they assumed? They will grow at an industry average of 3% after. That means grow after they have not given a definite life. Mint will invest all the money for capex in the infrastructure and equipment. Mint is planning to issue 50 million shares in lieu of the amount. Right? So Mint will invest all money for capex in the infrastructure. Right? And how will it raise? Through equity. ಅರ್ಥ ಆಗ್ತಾ ಇದೆ ನಿಮಗೆ? Equity. Mint will have to keep upgrading the infrastructure and equipment to cover different offices of various clients. Mint expects an initial investment of around 150 million. Initial investment, right? And then Mint needs to invest additional 10 million every year starting from beginning and is expected to grow at 10% every year. Artha aita? Each year 10% growth agi will keep increasing. The equipment investment varies with the number of the branches slash offices. This varies with the time and currently it is 0.1 million per office. This is my equipment investment. 0.1 million per office. Initially, Mint has won a tender of 100 branches of a bank and expecting to grow at 30% for the next 5 years. That means from period 1 to 5, it will grow at 30%. After that, it will grow at what rate? 10%. Clear? Mint is expecting to have a maintenance cost of 10% for equipment and 15% for network. To handle all this, current manpower cost is 1 million. Mint has entered into an agreement with local authority and has agreed to share 5% of the revenue with the same. Okay? Mint is expecting to generate revenue of 0.5 million per office. And to remain competitive in the market, it is not going to increase with inflation. Capital expenditure and operating expenses will grow at 10% every year. Tax slab in the country is 30%, and depreciation of the equipment and network is assumed to be 10%. Discounting rate is 20%. Is this clear, all of you? Tax is 30, depreciation is 10, discounting rate is 20%. Based on the above information, you are required to answer the following 5 MCQs. CFAT for year 1, CFAT of year 5, terminal value. Okay? And what is the total present value? Clear, all of you? Yes. Or IR also they've asked. Let's go to the answer. Yes. So if you see this, number of offices also they told is expected to grow at 30%. Yes, everybody? Got it? Number of offices growing. Revenue per office is given 5.5 million. Total revenue, multiply it. Then share of local authority, manpower cost, equipment cost, cost of network, total operating cost, EBITDA, less depreciation, EBIT, less tax, PAT plus depreciation, get CFAT. Is this clear, everybody? Huh? Now, why I'm doing this? Huh? Why I'm doing this is for this. X, Y, Z. Follow for your descriptive. Okay? When you're doing your this thing, all of you, what is this? When you're doing your MCQs, right? Capital expenditure is minus here. ಅರ್ಥ ಆಗ್ತಿದೆ ನಿಮ್ಗೆ? Capital expenditure is minus and then they have found net CFAT. Okay, then they have found net CFAT. So, what is the question? Come back. Yes, they've asked you CFAT, right? Not net CFAT. They've asked you the CFAT itself for year 1, year 5, etc. Okay. Acha, net CFAT they've not asked. If they use the word net CFAT, then this is how you have to compute. Artha aita nimge? I'm just what I predict is in the examination, right? Acha. Even though net CFAT they've asked, even though CFAT they've asked, they have used net CFAT itself. So examinationally, this is how you have to do. Intermediate capital expenditure, whatever is there, you take it in that respective year after CFAT. Got it, all of you? After CFAT, you take the capex, you get net CFAT. Is this clear? Mark it important for MCQs, huh? I want you to do like this only. because this is the format they are following for MCQs. And then these are your normal inflation cost, taking 10% inflation, arth aagta idea all of you, right? Then capital expenditure, how did they do it? Number of branches, many per branch, what is the cost? You take it and then you inflate. Got it, everybody? So these are very simple. I think you can solve this. Yes. This is very important. Terminal value using Gordon's model, Gordon's growth model. Terminal year cash flow into 1 plus G, NPDM. How do we do this? All of you concentrate. How do you find out what is the terminal year value? Right? You remember, right? P naught is equals to D1 divided by K minus G. Am I right, everybody? You know this formula, yes or no?
Yes. Yes.
Right?
Yes, sir.
Similarly, if I have to find out what is P6, I will take D7, right? Adhe tara illi, your P6 is equivalent of terminal value. This is my Pn. So obviously in the numerator, it will be Dn plus 7, right? So illi D badlu, you will take it as what? Cash flow. So cash flow n plus 1. Understood? There's nothing but cash flow n into 1 plus G. Is this clear? Divided by K minus G. Ade ಇಲ್ಲಿ ಮಾಡಿರೋದು. So this is that perpetual annuity. What you annuity andre annuity growth. What is there? Other the value. Then your normal cash flow. What is there for year 1 to 5? That has to come. Are you understanding? Everyone. Normal cash flow has to come. Then you find out what the discount is, and then you find what the total present value is. Is this clear? Yes, no. Okay. Now, a lot of confusions will be there. All of you concentrate now. Right? They have asked you, what is the total present value? Yes. So this is my total present value. Is this clear? That means I have taken the investments as well as the terminal cash flows, everything into consideration. When they ask you total present value, basically they're asking your NPV itself. You might get confused, sir. Are they asking only present value of cash inflow? Question is what? Check the question. I think they've asked you what is the total present value, correct? Have they used the word net?
No.
But is this net present value? 1 crore 67 lakh. Is it net present value? Yes or no?
Present.
100% yes, because you have considered capex here. ನೆನಪಾಗ್ತಾ ಇದೆಯಾ ನಿಮಗೆ? ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? You have considered the capital expenditure and then you have got the net CFAT, yes or no? Therefore, what you have identified here is basically your NPV. The question should have been very specific and asked you what is the net present value. But they have asked you what is total present value. For total present value also, I think they have given. Acha. Fourth question, Modi. What's the fourth question? Quickly read.
What is the total present value of some in technologies?
Total present value. Confuse Hagbedi. Don't tell, sir, present value of cash inflow. No. Total present value basically is asking NP. Is this clear? Right? I want you to mark this problem. Because, see, the problem is not at all complicated. It is a very simple, straightforward problem. Understood? But MCQ should not go wrong. So you should understand the way the institute is answering and we should also answer the same. IRR will not go wrong. Got it? IRR will not go wrong because the percentages are not very close by. They've given far off options. Am I right or wrong? Check. The options are not very close by. Yes or no? Check the options. Because what happens in IRR, there is an approximation error. Yes?
Yes, sir.
But the options, are they safe?
No, sir.
Okay. 1 second. Options one. Yeah. ಇಲ್ಲಿದೆ. This is what I told you. The answer is very safe. ಅರ್ಥ ಆಗ್ತಿದೆ. What do I mean by safe? They are far off. Right? 20, then 24. ಅರ್ಥ ಆಗ್ತಿದೆ ನಿಮ್ಗೆ. They are far off. So you can come to a close answer to this. Right? IRR. So anyway, they've given discounting rate of 20%. So that you can assume it to be the lower rate, and then you can see what the higher rate is. Understood? Yes. All right. So that's why they've taken 20%, right? Then at 20%, see all of you, better to take 20 because you've already calculated that NPV, yes or no? You don't have to calculate it actually again. Artha agta idya? So you're getting positive. To make it negative NPV, should you increase the rate or decrease it? Obviously, you have to increase the rate. Increase it and then you'll get the negative NPV. It doesn't matter. It doesn't have to be 25. It can be whatever rate. But suggested you add 5% so that you get a 100% negative answer. Is this clear? Then interpolation, you're getting 24.68%. Right? Then this is my MCQ, case scenario based question. There will be a normal question on investment decisions. Actually, they're not. Oh, they're not. All right. Yes. Next, your replacement decisions are important. All of you concentrate. Replacement decision. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? ಅದನ್ನ ಡೆಫಿನೆಟ್ ಆಗಿ ಮಾಡಿ. Incremental cash flows you have to consider. Incremental revenue. Anything that is incremental is considered. Any sunk cost not considered. Allocated overhead is not considered. Any cost that doesn't change or any cash flow that doesn't change with the change in decision is not required. Simple. Yes, I've done one beautiful problem on this for opportunity cost, sunk cost, allocated overheads. Our problem will go through madre, you'll get a lot of better. No, understand. A rupee saved is a rupee earned. Therefore, if there is any cost saving, you will consider it as a cash inflow. You consider it as a cash inflow. Okay. So these are some important adjustments of this chapter. Go through the entire notes what I've done in the class. Alright, we have spent about 1 hour on the capital budgeting. More than this I cannot spend in revision session. But it requires more effort from your end. Okay? All of you? All the concepts I've covered. Yes, problems, obviously everything I cannot do in the revision session. All right? Okay, I'll just glance through the material ones. First, so this page number 313. ಸುಮ್ಮನೆ just glance ಮಾಡೋಣ. Yes. Investment decision. Okay. So case scenario based question is there. This is your examination question 25. Right? So SR Limited manufactures steel rods and is now considering to purchase a new aluminum smelting and molding plant. Basically, plant investment cost 20 lakhs to purchase and install. Useful life is 5 years. Residual value 1 lakh. Production and sales from the new plant are expected to be 1 lakh units per year. Other estimates are as follows: selling cost and direct cost. Fixed cost including depreciation is 8 lakh per annum. Marketing and promotion cost not included in the above will be 1 lakh and 1 lakh 60,000 for years 1 and 2 respectively. Additionally, see, very important. Project life is 5 years. For each different slab of cash flow, you will have a different column. So if the cash flows are same for 1 to 3 years, then it will be 1 to 3. Then you can make 4, 5. Artha aita? But now it is very clear. This and this is different for year 1 and 2. So that has to be different. Additionally, investment in debtors and stocks will increase in year 1 by 1 lakh 50. Additional working capital, part of X. 2 lakh, part of X. Creditors will also increase. So minus madi, artha agta idya? Take the net working capital in year 1. Thus, debtors, stock and creditors will be recouped at the end of 5th year. The cost of capital is 18%. Corporate tax is 30% and is paid in the year in which the profits are made. Depreciation tax Is tax deductible? Company follows straight line method of depreciation. Very simple, straightforward question for 6 marks. Okay? Right? 1 mark for why? Advice. 5 plus 1. This is where you lose marks. Actually, now they're making it simple by giving you this 5 plus 1. Otherwise, they would have just given you 6 marks. And they may not have given this as a sub question. They would have just written advice. And you guys miss it. Now they're making it easier. But still in the old format, they can ask. So don't miss on the advice. Got it?
Yes.
All right. Okay. Fine. Then this is the discussion on investment decisions. All of you understood? Okay. So next chapter is working capital management or management of working capital. What is working capital? First of all, when I say working capital, gross working capital or net working capital, correct? The types of working capital. Gross working capital is basically your current assets, entirely current assets. Net working capital is current assets minus current liabilities. Current liabilities being only spontaneous current liability. Therefore, in other words, what you've learned in the class as defined by SS, what is what? It is that portion of the current assets which is invested by outside liabilities. Correct or not? Not by spontaneous current liability, which is that portion of the current asset which is sourced from my cost bearing funds. That is nothing but my working capital, net working capital. Clear? Now, what are the types of working capital? I told you based on amount, it is gross or net, based on your time period, right? It could be permanent or temporary working capital. The working capital which is required throughout is my permanent working capital. Working capital required at say seasonal period, etc. is my temporary working capital in addition to my permanent working capital. Example, what we discussed in the class, right? Bakery example, sweet shop example, Kanti sweets example, and all we discussed, right? During normal period also there'll always be sweets, right? But during Diwali they'll have additional sweets. Correct or not? Yes, ಮೊನ್ನೆ result ಬಂತು ಅವಾಗೇನು ಫೆಸ್ಟಿವಲ್ ಇರಲಿಲ್ಲ ಬಟ್ ಸ್ಟಿಲ್ ಸ್ವೀಟ್ಸ್ ಆರ್ ದೇರ್. ಕರೆಕ್ಟ್ ಹೌದು. ಆವಾಗ್ಲೂ ಸ್ವೀಟ್ಸ್ ಇತ್ತು ಅಂದ್ರೆ ಏನು ಹಿಂಟ್ ಕೊಟ್ಟಿದ್ದು ನಿಮ್ಗೆ ಏನು
ರಿಸಲ್ಟ್ ಬಂದಾದ್ಮೇಲೆ ಸ್ವೀಟ್ ಕೊಡಿ ಅಂತಾರ.
ನನಗೆ ಕೊಡೋದಂದ್ರೆ ಸ್ವೀಟ್ ಅವೈಲೇಬಲ್ ಇರುತ್ತೆ ಯಾವಾಗ್ಲೂ ಅಂತ ಅಷ್ಟೇ. ಓಕೆನಾ? ಸೊ ಕರೆಕ್ಟ್. ಬಟ್ ಡ್ಯೂರಿಂಗ್ ಯೋರ್ ದಿವಾಲಿ ಎಕ್ಸೆಟ್ರಾ more stock is kept. Seasonal fluctuation, temporary working capital. Right? Maximum permissible bank financially. This permanent working capital itself, I call it as core current assets. Core current assets. Anyway, when we discussed MPBF, we'll again come there. Okay? Yes. This is the types of working capital and the concepts of the approach. Next. Working capital investment. There are 3 different approaches. Concentrate all of you. Aggressive approach, conservative approach, and moderate approach. Investment get 3 approaches there. Financing also 3 approaches there for working capital. All are same: aggressive, conservative, moderate. Aggressive, you want to make immediate profits. Right? You want to make immediate profits. So therefore you keep minimum investment in current assets so that your working capital block is less. If lesser working capital is blocked, sharing cost is less. Clear all of you? Aggressive. But conservative. If you are aggressive, what happens? Right? No doubt your cost is less. Profits will be more. But at the same time, liquidity issues will be there, solvency issues will be there. Working capital is all about balancing PLS, profitability, liquidity, and solvency. Yes. So conservative, higher investment in current assets so that you're never out of stock. You're never out of stock. You don't have liquidity and solvency issues. Understood? But at the same time, cost is higher because of higher capital block, because of which profitability is lower. That is my conservative approach. Moderate is a combination of these 2 approaches. Right? So you have moderate profitability and moderate risk. Right? Next is your working capital cycle or your operating cycle. It is a time taken right from your manufacturing stage. So right from procurement of your raw material to conversion of WIP to finished goods, finished goods being kept in my stock for some time, then being sold, and the debtors then realizing cash. This entire cycle is basically your operating cycle. Understood? Operating cycle in terms of formula is very simple. Raw material holding period plus WIP holding period plus finished goods holding period, then plus debtors holding period minus your creditors holding period is nothing but your operating cycle. Is this clear? After this, there are different formulas. We'll be discussing all the formulas one by one later. How do you identify what is the investment required for raw material? What is the raw material holding period formula? What is the debtors holding period formula? All of them we'll discuss by looking at the material. But the next concept, right? Let's discuss the concept, then we'll go to the material. Estimation of working capital, right? So we estimate what should be the current asset value, what should be the current liability value by using the holding period and the average investment. Got it, everybody? Conceptually. Then we'll see the formulas, right? So current assets minus your current liabilities, you get your working capital required. From this, you add a safety margin, and then you get your working capital estimate. Is this clear? All of you? Yes. Then you have your receivables management, payables management, yes, and then finally your cash management. Inventory is part of costing. Clear? Inventory is part of costing. Okay. So with that, let us go through the CAPS material. Open page number 69. Management of working capital, chapter 9. Page number is matching?
Yes,
Yes,
sir.
sir.
Yes. Working capital, current assets minus current liability. Basically, this is my net working capital. Normally, when I say working capital, what we refer is the net working capital. Okay. So in general, working capital management is managing the current assets. Types of working capital based on value. You have your gross working capital, and based on time, you have permanent and temporary. Here you have gross and net. Right? Net working capital is current assets minus current liability. A positive working capital indicates the company's ability to pay its short-term liabilities. If working capital is to be calculated on cash cost basis, this is what is the normal approach followed. Then exclude depreciation, very important, and amortization from the calculation of WIP, finished goods, and sundry debtors. Okay, depreciation and amortization, both of them are excluded. Also exclude, right? Your net profit before taxes from sundry debtors. Basically, sundry debtors, put a circle and then put an arrow mark and write down cash cost. You have to consider the cash cost of sundry debtors. Permanent working capital, it refers to the base working capital. This is the minimum level of investment in current assets that is to be carried by the entity at all times, right? Temporary working capital, it is a part of the working capital which is required by the entity in addition to my permanent working capital, right? So this is what I discussed, your permanent working capital and fluctuating or temporary working capital. For a growing industry, this is how it will be as a slanting slope. We discussed the three approaches: aggressive, conservative, and moderate. Aggressive, low profitability, mentioned there. Low profitability. Aggressive, high profitability. Aggressive, high profitability, low liquidity and solvency. High profitability. For conservative, low profitability but high liquidity and solvency. Right? Moderate, it balances between the risk and return. It's a combination of my aggressive and conservative. Operating cycle, it means the time taken, right? Wherein the initial cash invested is converted into final cash through sales to customers. Estimation of current assets formula, raw material, estimated production units into estimated cost per unit into average raw material storage period. Cost is basically cost of raw material. Put an upward arrow, cost of raw material. ಇಲ್ಲಿ raw material estimated RM ಅಂತ ಪ್ರಿಫಿಕ್ಸ್ ಮಾಡಿಲ್ಲ ಅಂದ್ರೆ RM cost per unit. WIP estimated production units divided by 12 months or 365 days into estimated WIP cost per unit. That is until the stage of production. into average WIP holding period. Finished goods, estimated production units divided by 12 months or 365 days into estimated cost of production. Cost of production into average finished goods period. And then for receivables, you have cost of sales. Mark it important. This is the only place where we take cost. In ratio analysis, we will take the sale value itself. Only for estimation of working capital, you will consider cost. In fact, even for estimation of the collection period or the debtor's velocity, you will not consider cost. You will consider at selling price itself. Artha. Even in FM, for calculating the velocity, you will consider at sale value. Only for calculating the estimation of the current assets, you will consider cost of sales. Right? Cash and cash equivalent, basically the minimum cash and bank balance that is required, normally given in the question. Estimation of current liabilities, estimated credit purchase. This one more thing you have to circle, credit sales units. Cash sales you will not consider. Right? Similarly here, credit purchase. Direct wages, estimated labor hours divided by 12 months or 365 days into wage rate per hour into average time lag. Underline this, average time lag in payment of wages. Same way, average time lag in overheads. Estimation of working capital, current assets, less current liabilities, add safety margin, and then you get your net working capital. Right? So your cash management models, or if you concentrate, you have your Baumel's EOQ model, same thing as my EOQ, square root of. There you have A, B divided by C. There it is annual demand of input. All of you consider it annual demand of input. Here it is the annual cash demand. Understood? Annual, what is the demand of cash? That is what you consider here. So 2A, however, there you had your ordering cost per order. Here you have your finance cost per transaction F. Right? So 2AF divided by,
Oh,
there you had your carrying cost per unit per annum. Here you have your opportunity cost. So divided by O. Understood? Use the same notations as we had discussed in the class. Same notation as we discussed in the class. UPS and all you will not remember. Adike. Artha.
yes, sir.
Miller or cash model. Very simple. 3 levels are considered here. Return point, connects it straight. Return point, upper limit and lower limit. Clear all of you? Yes. Return point, upper limit and lower limit. What happens to cash? It keeps fluctuating. Okay. When it reaches your upper limit, right? That means whatever additional cash is there, that is connects difference between your return point and your upper limit. Whatever is additional cash is there, what you do, you invest it and you get the cash back to the return point. Understood? Then again it fluctuates. If it reaches the lower limit, oh, cash is short now. Sell your investment, get it back to the return point. This is basically your Miller model. Right? Miller or cash management model. Net cash flow cannot be predicted precisely as per this model. Net cash flow is completely stochastic, cannot be predicted precisely. Yes, control limits are set. Upper limit with notation H, return point with notation Z, lower point with notation 0. Right? When cash balance reaches the upper limit, transfer the cash equal to H minus Z to your into marketable securities. Invest it. Basically invest. When it touches lower limit, sell the marketable securities and get it back to cash account. Right? All right. Payables management. Always remember, nothing is free. Right? Nothing is free. In capital structure chapter also, I had discussed that nothing is free in financial markets. Same way, nothing is free. Oh, spontaneous current liability. So it is self-generated current liability in the day-to-day operations. Free of cost? No. Nothing is free. If you pay the creditor earlier, he would have offered you a cash discount. Yes or no? Therefore, for availing the credit period, Pavitra, you are giving up on the cash discount. Correct? For availing the credit period, you are giving up the cash discount. Yes or no, everybody? For giving up the cash discount, that cash discount becomes your opportunity cost. Right? Now, if you pay upfront and you avail the cash discount, then what are you leaving up? You are going to pay the cash upfront. Had you kept the cash to yourself, you could have invested it somewhere. So opportunity cost you're losing. Yes or no? So nothing is free everywhere. So now how do you decide whether you avail the cash discount or not? If the discount rate offered, right, effective discount rate, what you have to calculate based on the formulas. If that is more than your opportunity cost, you go for cash discount. Less, you go for your, you go for the credit period, basically. Okay. So cost of availing trade credit, price, loss of discount. You lose on the discount. Cost of managing the creditors. If you have a credit period, you have to manage the creditors, right? Cost of not taking the trade credit, impact of inflation will be there, and interest. Computation of cost of payables. Simple formula is D divided by 100 minus D into 365 by T. If you take the compounded formula, right? 100 divided by 100 minus D to the power 365 by T minus 1. This is my compounding formula, simple interest formula. Got it, everybody? Right? Risk return management, this is what I told you. Basically, current, it's C and chartered accountant, current asset. Okay, now? Yes. So, balancing PLS. Balancing PLS. Higher the risk, higher the return. This is what you have to cover. Balancing PLS, higher risk, higher return. Lower risk, lower return. Conservative, low risk, profitability lower. Aggressive, high risk, high profitability. Artha aita? That is what is your risk return trade off, risk return management. Factoring. In your receivable management, you have factoring wherein your receivables can be outsourced to a third party. Yes or no? Can be given out to a third party. That is basically factoring. So it's a financial service wherein there's an arrangement between you and the financial institution. Okay, wherein the firm will receive an advance. That is, you will receive an advance against the receivables. All of you understood? So basically, because of time value of money and to lessen your administration cost of your debtors, right? You get the money in advance, they will manage your debtors, they will follow up, they will collect the money. Clear, all of you? That is fact. Right? However, there are two types, recourse and non-recourse. Recourse means if there's a bad debts, you have to bear it, they'll come back to you. Non-recourse, bad debts, they will handle it. It's their headache once everything is clear. So obviously, the commission under non-recourse will be more than recourse. Clear? Right? So factoring is a financial service arrangement between firm and financial institution under which the firm receives advance against receivables from the financial institution called the factor. On the basis of risk, there is recourse and non-recourse factoring. On the basis of amount, full or partial. Cash budget, right? Cash budget is the most significant device to plan for the control of cash receipts and payments. This represents cash requirements of business during budget period. Factors affecting working capital. Nature of business, scale of operations, length of operating cycle, production policies, rapidity of the turnover. That means how fast, right? Seasonal nature of the business, operating efficiency, credit policy, dividend policy, and other factors. These factors influence your working capital. One more thing, what is not covered, receivables management. All of you concentrate. Main problems that you get is one is factoring type of problems and choosing the credit policy, right? Should you go, they would have given you various options, which option to go for. Clear, all of you? You know ABCD cost discussed in the class. Okay, you have your administration cost, bad debt cost, NPD Enadro, all of you. Yes. So all of these costs you have to consider and then see, is it better to go for lower credit period or higher? Normally, what they'll give you, lower credit period, lower sales, higher credit period, higher sales, higher debtors, and higher bad debts. Understood? So, incremental revenue, basically incremental revenue and incremental contribution is what you have to consider. Clear? Fixed cost is not relevant because it's already sunk in nature, already covered. Incremental contribution for your increase in the credit period minus your incremental costs. Arthak Tedya Kanishk. Incremental contribution minus incremental costs. If it is positive figure, go for higher credit period. Otherwise, go for the lower credit period. So choosing the optimum credit policy, these type of questions come in your receivables. All of you understand? Yes. Let's go through your RTP. Yes, question number 9. Management of working capital. A firm has a total sale of 200 lakhs, of which 80% is on credit. It is offering credit terms 2 bar 40 net 120. What does it mean? Discount rate will be 2% if it is paid within 40 days. If you're not availing for cash discount, then the net credit period is 120. Clear? Of the total, 50% of customers avail of discount and the balance pay in 120 days. Okay, so 50% customers avail for the discount, others pay in 120 days. Past experience indicates that bad debt losses are around 1.5% of the credit sales. The firm spends about 2,40,000 per annum to administrate credit sales. These are avoidable as a factor is prepared to buy its firm's receivables. He will charge 2% commission. He will pay advance against receivables to the firm at an interest rate of 18% after withholding 10% as reserve. So whatever your receivables is, minus 10% minus the commission he will give you. Understood? Determine the effective cost of factoring. Consider a year as 360 days. If bank finance for working capital is available at 12% interest, otherwise should the firm avail the factoring service or not? Right? Very simple, straightforward question. Yes. So total sales is 200 lakhs. All of you concentrate. Total sales is 200 lakhs. 80% of that is how much? 160 lakh.
60.
Correct? Then they said 50% of this avail for discount. That means they pay within 40 days. Others pay in 120 days. Got it? Right? Average collection period therefore is 40 into 0.5, 120 into 0.5, 80 days. Is this clear? Right? Average level of receivables 1.6 crores into 80 by 360. Any doubts here? Right? Into the credit period divided by 360 will give you the average receivables, that is 35 lakhs. Factoring commission, very, very important. This is monthly, alwa. Every month you will do this. Okay. So factoring commission 35 lakh 55,556 into 2%, 71,000, 10% reserves. Right? Amount available for advance is this minus, right? Minus reserves plus commission. Right? You minus it, you get 31 lakh of advance. You are getting this in advance. Factor will deduct his interest at 18%. Therefore, this into 18% into 80 days divided by 360 days into 100. So 18%, so 18%, so 18 by 100. So this is the interest cost. Advance to be paid is 30 lakh 3,733. Now, because I'm getting this in advance, all of you concentrate, because I'm getting this in advance. Otherwise, I'd have got it 80 days later or on average. Yes or no? I'm getting 30 lakhs in advance. Annual cost of factoring to the firm would be factoring commission 71,000. This one divided by 80 into 360. Clear? Same way, interest charge divided by 80 into 360. This is my annual cost. Firm's savings on taking the factoring service. Cost of credit administration saved 2,40,000. Administration cost saved. Bad debts cost which is avoided is 2,40,000. 4,80,000 is saved. Net cost to the firm is 8,83,000 minus 4,80,000. 4,03,000. This is what is saved on this, right? Effective cost of factoring 4,03,000 divided by 30,03,000 into 100, 13.42%. Right? If bank finance for working capital is available at 12%, firm will not avail factoring service as 12% is less than the factoring cost. Artha. See, what does it mean? The benefit I'm getting is 12%, yes or I mean 13, whatever. The cost, factoring cost is for me 12% cost. Artha. Other than that, rather than taking that, incurring this 13% cost, I might as well take a bank finance. Understood? Therefore, that is a convention. Artha, all of you. Yes. Then you have your estimation of working capital related problems, wherein all of you concentrate, wherein you have to take the cash cost approach. right? Cash cost always. For debtors also, you have to consider cost of sales, extremely important in estimation of working capital problems. Operating cycle is very easy to do it. That formula you should know: R plus W plus F plus D minus C. Clear, all of you? Apply that formula, you will get operating cycle. Estimation of the working capital using operating cycle, right? Annual operating cash cost divided by my operating cycle will give you your estimation of working capital. Nenpidiya, all of you, right?
Yes.
So divide by the number of days into my operating cycle will give you what is your estimation of working capital, right? Next, this is with respect to your introduction. Receivables are already I discussed. One the factoring, ಇನ್ನೊಂದು choosing the optimum credit policy. Payables management is very simple. And last you left with your cash budget. A cash budget ನಾನು ಕ್ಲಾಸ್ ಅಲ್ಲಿ ಮಾಡಿ ನಾನು go through ಮಾಡಿ. ಅರ್ಥ ಆಯ್ತಾ? In estimation of working capital, export related problem ಇದೆ, very important. Go through that. What I've done in the class. What is important is cost for the export doesn't change. Only the selling price will change. Got it? So using your marginal costing principle, same principles you will apply here. Find out what the cost is for the entire thing, because for estimation of current assets, cost is important. It's not the same. Is this clear? Right? All right. The last chapter is ratio analysis. So we'll go through ratio analysis, and after that, I'll be going through the latest suggested answer and one MTP. Just glance through it, and with that, we'll be concluding today's session. Yes. Ratios. Most of the ratios are simple. 90% of the ratios are ratio ಹೆಸರೇನಿದೆ ಅದೇ ಇರುತ್ತೆ. Right? Debt equity ratio. What is it? Debt by equity. Clear? Yes, like that. You have most of the ratios, whatever the name says, that is what the ratios. Certain important points are there which I had very in detail, beautiful notes we have this time. Okay, adana go through madi. Wherever important points are there, I told you. For example, turnover related ratios, right? Or performance ratios, efficiency ratios. There, turnover, asset turnover ratio. Asset is first, turnover is later, but numerator ಏನು ಬರುತ್ತೆ?
Turnover first.
Turnover.
Turnover.
Then
Asset comes in denominator. All turnover ratios, turnover is in the numerator. There it will be turnover or COGS, right? Most of the you should know where COGS is used, where turnover is used, right? Inventory ke COGS. Understood, all of you? Right? Debtors turnover ratio, you use credit sales. For your, creditors turnover, you will take credit purchases. Clear, all of you? Like this important points, note on my first. Most of the, a table what is given in your notes now, that should actually form part of your revision. That entire table, it's actually part of your revision. I would suggest you to read from that table itself. Got it? Yes? All right. Now open your revision material. Let's go through all the formulas.
Page number 25.
25, no? Yes. Financial analysis and planning, ratio analysis. Basically, it helps to analyze the following. Is the company solvent in the long term? Right? Leverage ratios. Other capital structure and coverage ratios. Under capital structure, equity. Shareholders' equity divided by net assets. Illi division, net assets. Debt ratio, again divided by net assets, total debt. Debt equity, debt by equity. Debt to total assets, total debt by total assets. Capital gearing ratio, fixed percentage bearing funds divided by owner's funds. So preference shares also comes in the numerator, right? Proprietary ratio, proprietor's fund divided by total assets. Difference between equity and this is in equity net assets, in proprietor's fund total assets. Coverage ratios, right? Interest coverage ratio, whatever is being covered will be in the denominator. What is covering it will come in the numerator. EBIT by interest. Fixed charges coverage ratio, EBDIT divided by interest plus repayment of loan, right? Then your debt service coverage ratio, EBDIT into 1 minus T, that is after tax, PAT plus interest plus depreciation divided by interest plus repayment. And preference dividend coverage ratio, PAT divided by preference dividend. Equity dividend coverage ratio is PAT-ish divided by equity rent. Clear, all of you? Right? Then how is the company, right? How profitability is the company? That is your short-term ratios. All these profitability ratios based on sales, your net profit, gross profit, operating profit ratio. That is your sales minus operating cost. Clear, all of you? That's operating profit. Based on sales expense ratios, COGS ratio, operating expense ratio, operating expense, the operating cost, your normal COGS, etc. You have to not consider, only operating expense, selling and administration expenses normally. Clear, all of you? Yes. Then comes your operating ratio. Operating and the profit alla, it's operating cost. It includes your direct cost as well as your indirect cost of selling and administration. Is this clear? Right? Then financial expense ratio divided by sales. Return on investment, return on assets. It can be EBIT or EBIT into 1 minus T, and PAT also sometimes considered. Return on capital employed, EBIT or EBIT into 1 minus T or PAT plus interest divided by capital employed. Capital employed in FM is always equity plus debt, not just equity. Clear, all of you? Or other formula is what? Total assets. Total assets excluding your fictitious assets. Fictitious assets always adjusted with your capital. Understood? So minus current liability, that's nothing but net assets. Right? That is nothing but net assets. Is this clear? Right?
Yes.
The return on equity is Patish divided by T. Next, owners ratios, dividend, DPS, dividend payout ratio, price earning ratio, I'll add ಮಾಡಿ price earning ratio, dividend yield ratio, dividend by MPS, dividend yield ratio, it's not covered there. Dividend yield ratio, Q ratio, ಅದು ಅಲ್ಲೇ ಬರುತ್ತೆ. Right? Q ratio is what? Comparison of the replacement cost with the acquisition cost. Right? Next, is the company efficiently utilizing its assets? All turnover ratios. Right? Sales or COGS in the numerator divided by turnover of whatever we are considering. Company's ability to meet short-term obligations or liquidity or solvency ratios. Current ratio, ideal 2:1, formula current assets by current liabilities. Quick ratio 1:1 or acid test ratio, right? Current assets minus your inventory, minus prepaid expenses or cash and cash equivalents plus trade receivables. In the numerator, divided by current liabilities or cash ratio, that is cash and cash equivalents divided by current liabilities. Next comes your basic difference interval ratio, quick assets divided by daily cash operating expense. When I say daily cash operating expense, it's everything, including that's basically your operating cost. Net working capital, current assets, and current liabilities. So this is a summary of all the ratios and cash ratio, quick ratio, and current ratio, right? Current ratio is normally for less than 1 year. It includes my inventory as well as trade receivables. From this, if I minus my inventory, I get what? Quick ratio. From this, if I remove receivables, I get my cash ratio. Right? DuPont model, ROE, return on equity, is a factor of 3 things. First one is your profitability ratio, net profit, PAT by sales, then turnover ratio, sales by total assets, and then equity multiplier, total assets by shareholders' equity. Is this clear? Right? So all the ratios are given here. Again, right? You can go through all of them. Each of the ratios is given. Understood? Everybody?
Yes, sir.
Right? Then uses and objective of financial analysis, a bird's eye view. Basically, for each shareholder, what is his objective? What are the ratios that he will basically use? A table of that is clear. Okay. Now come to your RTP. Right? Ratio analysis. Jamunapati Limited has furnished the following ratios and information relating to the year ended 31st March 24. Sales is 70 lakh. Return on net worth is 25%. Okay. Then rate of income tax is 30%. Share capital to reserve 7:3. Current ratio is 2. Net profit to sales is 7%. Sales is given. Net profit to sales is given. So you know what the net profit is. Clear? Inventory turnover ratio is given 10. COGS is given. Using COGS, you can connect inventory turnover ratio and then COGS. Yes or no? All of you. Interest on 15% debentures, 1,05,000. Therefore, debentures, can you find out? ಹೇಳಿ 15% debentures 1,05,000 is interest ಅಂದ್ರೆ debentures you can find divide by 15%. Yes or no?
Yes, sir.
Yes, sir.
Receivables is 3 lakh, payables is 3 lakh. Right? You are required to calculate operating expenses for the year ended 31st March 24. Prepare a balance sheet as on 31st March 24 in the following format. Right? What I think. Again, very simple. Okay. This is not, I don't see any complications here. Problem number
4.
4. Yes. Easy step by step. Yes. Return on net worth have given 25%. Right? Therefore, profit after tax of 4,90,000 is equivalent to 25% of net worth. So total net worth is 19.6 lakh. Right? Then they have given share capital to reserves and surplus. You split it, you get share capital and reserves. Artha aita? Again, important to note. What you should note here? Sir, when they say return on net worth ಗೆ return ಏನು? Obviously, it has to be PAT. Don't take before tax. Artha aita? Some of the questions students come and ask, sir, PBT, there is no question of PBT here. It has to be PAT because that is the return for net worth. They are the owners. Owners get has to be after tax. Clear? Debentures I told you at 15% divided by 15%, 7 lakh. Current ratio they've given 2, right? Payables is given. Normally payables you can assume it to be current liabilities. Yes. Right? So current assets 6 lakhs. This is a very important assumption. Market important. Right? So fixed asset is basically balancing figure. Balancing figure. Artha aita? Composition of current assets, right? So inventory turnover ratio is 10. I told you you can connect your inventory turnover ratio and COGS to find out closing stock. Yes, COGS by closing stock is equals to 10 andre. Obviously, closing stock is 2,40,000. From your current assets, receivables is given in the question. Stock is 2,40,000. Cash is balancing figure. Clear all of you? That's it. Substitute the figures, your balance sheet is constructed. Okay. Now, come to your main part. We'll just go through a few problems of ratio analysis. 101. So again, this is a similar type of problem. Stock turnover ratio is given, cash and bank balance, GP ratio, creditors turnover, debtors turnover, net fixed assets, 25% of total liabilities, depreciation, current ratio, capital gearing ratio. All purchases and sales are assumed to be on credit basis. Figure they have given share capital. Now this will be my starting point. Right? Share capital is given. Any other figure? Current liability total is given. Okay. Current liability total is given. Share capital is given. So, okay. So you can use current ratio and equate it with current liabilities and do it. Yes. Yes. So that is the starting point. I told you. Clear all of you? Only thing is it was net of prepaid expense that has to be added back. That you mark it important. There it was net of added. So current liability is 52.5. Use current ratio, find out current assets. From current assets, then you do the, working back of all of it. Understood? Yes, no. Right? Next, calculation of fixed assets and total assets. Fixed assets, 25% of total liabilities or 25% of total assets. Yes or no? Total assets is nothing but, in FM, FA plus CA. Therefore, if fixed assets is 25%, current assets is 75%. Yes, all of you. 75% of total asset. That's it. Now we have found out current asset is 84 lakh. This 75%. Find out total asset and then multiply 25%. You'll get fixed assets. Artha aita? Right? Once you have found out total assets, You know current liability, total asset minus current liability will give you what? Capital employed. Clear? Right? So like that, you have to work back and then solve the problem. Wherever there is X, no? Go through that and do it. Artha then different problems. Sometimes X is not required if liquidity ratio and cash ratio is given. You can express this in terms of this. We have done these problems. Nenpidia, there are two approaches. One is to use X. One is to use this. This method is always suggested. However, this is for sales. So illy you have to use X and do. Got it? This is very important. Proprietary ratio, right? In many places, they've used the word net fixed assets divided by proprietary fund. Okay. Idana, just go through money. One or two places it has come. September exam people, especially Nivo, time illa anta madbadi. You have to, what you have to do is you may not be able to solve all the problems, but at least go through all the problems. But you have to definitely solve. There's no doubt about it. But yes, I understand you cannot solve everything. Whatever you find different, adana note down man. Right? Those adjustments at least you solve. Clear? Right? Like I said, that proprietary fund that is there in couple of places, other note code. Yes. Yes. Think. There's one more problem where now equation use ಮಾಡ್ತೀವಿ. I'll just tell you. X ಅಂತ problem number April 22 MTP. April 22 MTP, question number 16 in your material, page number 153. Okay, mark that. Adana go through my. Like that, there are different type of problems. I'll go through from my end, whatever I can have highlighted. Others you go through and mark all the important adjustments. Clear everybody? Yes. So we are well within time. Let us go through the suggested answer and one MTP. Page 550. Okay. Now, I think from the recent exams, first exam al ಕೊಟ್ಟಿರಲಿಲ್ಲ ಆಮೇಲೆ ಈಗ ಅವ್ರು ಕೊಡ್ತಾ ಇದ್ದಾರೆ MCQ. Right? They're giving, so we have the question also. Right? So part 1 MCQs, all of you know. Right? So the case scenario based question is there. You have to answer 1 to 5, 2 marks each, normally 10 marks. Okay? Then case scenario 2 is there. Now, so earlier they were giving independent questions. In the last examination, they gave another case scenario itself. Gotaita? Yes. So for 2 marks each. Again, and then for 1 more mark, they ask 1 more MCQ. Got it? Yes. And this is, I think, your strategic management. Okay. I'll not touch that. Strategic management. So total 30 marks MCQ ಬರುತ್ತೆ. Clear?
Yes.
Then financial management part 2. Question number 1 is compulsory. Attempt any 2 questions out of the remaining 3 questions. Now, last question normally theory irutte. Okay. So question number 1, right? You got this first question, right? Cash budget problem, 5 marks. Working capital. Then leverages. Look at this, 5 marks. Leverages 5 marks, right? And then again 5 marks for dividend decision. Look at this. In your compulsory question itself, 10 marks covered. What I always say, leverage is 5 marks, dividend decisions 5 marks, and that you go through easy questions. Easy questions, straight away 5 marks will be in your pocket. Okay. 15 marks. Question number 1, if you observe, for 5 into 3, 15 marks. Okay. Next, question number 2. All of you look at this. Following information about CMC Limited is given, and then total market value 12% bank term is at par. Cost of equity, cost of convertible, cost of capital 7 marks. Cost of capital 7 marks, right? Then your operating cycle, again working capital, right? 3 marks, total 10 marks. Kanta idea, all of you, 10 marks, right? So your other descriptive questions will be for 10 marks each. So 10 plus 10, 20 plus 15, 35 plus 15, 50 marks. Got it? Right? So cost of capital problem and working capital. Next, question number 3. Normally this will be a capital budgeting question, 6 marks, right? Sometimes 8 marks bandide, sometimes entire 10 marks also has come. Artha agta idya? Capital budgeting. This normally these 6 marks and all easy irutte. This is what I went through. Easy, yes or no? Very easy problem. Then for 4 marks, you're required to prepare balance sheet of Sky Limited, ratio analysis, 4 marks, 10 marks, right? And then your last question, how many theory question? This is ಈಗ ನಿಮ್ಗೆ ಗೊತ್ತಿರ್ಲಿಕ್ಕಿಲ್ಲ, environmental, social and governance linked bonds. This is from your chapter 2. Discussion of wealth maximization goal of financial management, right? This is from chapter 1. Study 2, advantages of virtual banking, right? And state the concept of exclusion of finance cost principle. Yeah, chapter idu, you all know this. Exclusion of finance cost principle. Where did we learn? Today only we saw. Capital budgeting, investment decision. Discussion aitalva. In KO already interest is there. Therefore, while discounting it, we take only EBIT. We do not consider EBIT minus interest for CFAT. Nenpidiya?
Yes.
The same thing is for 2 marks they've asked. All of you understood? Yes? No? Clear?
Yes.
Right? Shall we go through one MTP? The strategic management window. Yes, this is your MTP. No. Yes. So 50 marks, MTP. Case scenario, question is given again. Yes. Question will be lengthier than the answer. Don't get scared. You know, a lot of story will be there. Take only what is relevant. Got it? Right? So incremental benefit of adopting credit policy A to the company is, right? Credit policy B, right? Evaluate the proposed options of inventory management and select the best sequence as per their rankings based on benefit analysis to the company in the form of sales. Proposal, which proposal has to be selected, bad debt expenses, right? Working capital management related is the first case study. All of you go through and solve this case study. Okay. Next. Right? They have asked independent questions. Next is independent questions of 2 marks each. Are you able to see? Right? I think dividend decision idu has declared dividend. Yeah, and this is easy question. Then details of XYZ Limited are as follows. Leverages, okay, 2 marks. Risk-free rate of return using which approach?
CAPM.
CAPM model, 2 marks. Sorry, 1 mark. Okay. Then descriptive question, 35 marks. Question number 1 compulsory. Any 2 of the remaining 3 questions. Same thing it will be there. So discounted payback period, desirability factor, which is nothing but profitability index and net present value, 5 marks. Capital budgeting, right? YTM method only, to find out cost of convertible bonds. This is basically your IRR method. Yes or no? Yield to maturity method is nothing but IRR. 5 marks. Cost of capital, right? Then leverage. Remember, I've done this in the class. You have financial plan, 2 financial plans you have, right? And then situation 1 and 2. Arrow mark ಮಾಡ್ಕೊಂಡು ಮಾಡಿದ್ದೆ. Situation 1, then situation 2, and then financial plan A, B. NPDya? Done in the class. Same thing, 5 marks. Right? Question number 2 for 10 marks. Otherly, sub question A. Dividend decision, 4 marks. Can you see? Yes. So 5 marks plus 4 marks, 9 marks. I told you already. Right? approach and traditional approach. I've done this in the class, right? Equity capitalization. So when the debt value is increasing, interest value is increasing, equity capitalization rate, you find out what is the KO using the formula. Yes, KO formula use ಮಾಡಿ, find out what KO is, and then we will choose whichever is the least KO. That will be the optimum combination of capital. Clear? Under traditional approach. Under approach, what will you use? Net operating income approach, one formula we are told for KE, what you can use anta RO divided by debt, D by E use ಮಾಡ್ಕೊಂಡು ಒಂದು formula ಇದೆ. Okay, that formula you have to use it here. This also I have done in the class. Okay. Yes. So anyway, what is important here is the pattern. I hope you are understanding the pattern, everybody. Okay.
Yes.
So 10 marks you got. 10 marks. Question 2. Next question 3. Here ratio analysis. This should be, I think, for 6 marks. Okay, 8 marks. 8 marks and 2 marks. Look at this theory. Write a short note on internal rate of return. Right? What is IRR? Define what IRR is. Right? Add internal rate of return, present value of cash outflow equal to present value of cash inflow. Right? It gives you the return. What is the assumption? Intermediate cash flows. It is assumed to be reinvested at IRR. Now, Adela points value for 2 marks. Explain the following types of leases. This will be in introduction chapter. I will be teaching you guys later. Anyway, most of it you would have learned it somewhere or the other. Alva? Sale and lease back accounts are bandidya? Leases in agila. Okay. Anyway, I'll also be teaching it. Explain any 4 features of debentures of bond. Chapter number 2. This is chapter 1. Discuss conflicts in profit versus wealth maximization principle. Chapter 1. Right? Explain the brief concept of overcapitalization. Have you learned it? Yes. Same thing. Easy. So, are the theory difficult? Is theory difficult? See, chapter number 1 and 2, obviously I'll be discussing, but even in that, profit versus wealth maximization, we've already discussed in detail. That is what is asked here. Then, overcapitalization, you already know all this, okay? So, do not ignore theory. Once we have discussed it, please concentrate on theory also. Okay? Everybody? So, with that, we've comprehensively covered all the concepts. Definitely, I would have not covered all the problems, but all concepts I have touched upon, which will be covered, which comes in your problems. I hope it has helped you to recall whatever you have already learned. And now, ball is in your court to give it your best. Treat the mock exam like an actual examination itself. I will definitely be there in the valuation session to help you guys, analyze how you have written the paper. Irrespective of your preparation, please write the examination. Irrespective of the preparation, doesn't matter what you score. What is important is you will understand how to time the paper, especially for FM and SM. Especially for FM and SM, where one is practical, other is theory. Not an easy job. You need to practice. Got it? Timing, because time is the entire 3 years only. But how do you time everything? Sir, nimge ಇಲ್ಲ ನಾನೇ ಹೇಳ್ತೀನಿ ನಿಮಗೆ. Okay, so wait, I'll give you the breakup, normal breakup that we use. Okay, ಅದನ್ನ note down ಮಾಡಿ. R2R. One second. 2 minutes. I'll just share it. Yes. You can quickly note this down. Okay. So order of selection of questions is preferred. FM descriptive. Start with this. Follow ಮಾಡಿದ್ದನ್ನ. Okay. 2 to 210 scribble. 210 scribble. The 100 mark paper ತಾನೆ ನಿಮ್ಗೆ ಇರೋದೀಗ?
ಹಾ ಸರ್ ಹಾ ಸರ್
Yes.
Yes,
So
sir.
3 hours paper. Follow the time. Follow the timeline as much as possible, or from whatever time you start. I don't know if you will be starting at 2, but normal, this is the normal time. 2 to 210. Scribble in the last page important points of some questions. I think in other papers also, sir, will discuss this. Yes, similar approach. 210 to 240. That is half an hour. First question selected. Best and well-known question. Best and well-known question. Then 240 to 3. Second question selected. 3 to 315. Last question selected. Got it, all of you?
yes sir.
Right? Normally we say don't start with question number 1, but sometimes even the 5 mark questions may be easy. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? 5, 5, 5. It may be easy if you are confident, because this has more time and there are 3 questions to solve. You can choose that also. Your theory question you can do only if you are very, very confident of scoring the highest in theory. Got it? Otherwise, I would not suggest you to start with theory. The theory can be in one of these 240 to 3 or 3 to 315 slot. ಅರ್ಥ ಆಯ್ತಾ? Right? Then
Yes.
MCQ of both FM and SM, 315 to 355, where majority time will go in FM because SM ಅಲ್ಲಿ ticking ಇರೋದು. Right? SM is ticking. So understanding the case study is important. Definitely you need to spend time to understand the case study, but answering is very quick. Am I right or wrong? I'm not an SM expert, but common sense by looking at the paper I'm telling. Correct? Normally case study ಕೊಟ್ಟಿರ್ತಾರೆ, questions ಕೊಟ್ಟಿರ್ತಾರೆ, answering is not a problem. Understanding the case study you need to spend some time. Majority of the time would go in FM here, but yes, hanganta you cannot ignore SM. SM is also equally important. And then balance SM descriptive, 355 to 415. First question selected. Best and well-known question. Always your answer, your mark should be descending order. I'm happy if it is all out of out. Okay, if it is not out of out, it should be descending. Your highest mark should be the first question. It has an impression on the evaluator. 415 to 435, second question selected. 435 to 450, last question. Last 10 minutes, go through the remaining questions, and left out question, just scribble something, because if there is any out of syllabus, you might get grace marks. This is the plan. I hope you all have noted it down. Okay?
ಮೋಸ್ಟ್ಲಿ ಸರ್ ಒಂದೇ ನಿಮಿಷ.
So follow it. ಮತ್ತೆ ಶೇರ್ ಮಾಡ್ಬೇಕಾ?
Yes, sir.
Yes. Okay, what is important? The time ಬರ್ಬಿಡಿ ಅಷ್ಟೇ. 10 minutes, then 30 minutes, then again, then the 20 minutes and 15 minutes for FM. Right? Here, half an hour, and then 20, and then 15. Same thing. Right? MCQ ಅಲ್ಲಿ it will be skewed more towards FM than SM. Normally, that's what the students have told. But that you have to time. Considering everything together, everything together, normally 1.5 hour ಇರಬೇಕು. But I understand that for some students, FM ಗೆ ಜಾಸ್ತಿ ಟೈಮ್ ತಗೊಂತಾರೆ when compared to SM. Don't go beyond 1 hour 45. 1 hour 45 and 1 hour 15. ಅರ್ಥ ಆಯ್ತಾ? Don't go beyond. I'm the FM faculty, I'm still telling you, don't go, because please understand that you have to average out your marks. You cannot, what is the point of scoring 50 on 50 in FM, but scoring say 10 out of 50 or like 15 out of 50, what I'm just telling you. There's no point. Rather score 70 or 80 out of 100. Got it? Minimum. You know, Pavitra? Minimum. Yes. That is the minimum target. Correct, Allah? I want 100 on 100 only, always. Aim for 100. I'm happy even if you get 80 plus 90 plus. Okay? It is possible. Do not ignore SM. Do not ignore SM. Many students nowadays ulta ಆಗ್ತಿದೆ ಮುಂಚೆ FM ಕಷ್ಟ ಅಂತ ಅದಕ್ಕೆ nowadays I'm seeing they are ignoring SM because of which they are suffering. Don't do that. Don't do that. Concentrate both on FM as well as SM equal. Okay? Any doubts, any questions you guys want to ask, you can ask. Otherwise, we can conclude today's revision session. You have 7:30 session, alva?
sir.
Yes, sir.
That's it. All right. Thank you, everybody. Bye, I love you.
Thank you, sir.
Thank
Bye,
you,
sir.
sir.
Bye, sir.
Thank you, sir. Bye, sir.